Welcome to this video series about measuring value creation in private equity, where we talk about the best way, the right way, the only way really to measure how leverage and growth capital drive private equity returns. My name is Mike Reinert. I've worked in the industry for 15 years. I run the AUXILIA Mathematica website, and I wrote the book Private Equity Value Creation Analysis. These videos cover findings from my work, website, and book, and they're designed for private equity practitioners who use data to raise capital or evaluate the returns of private equity deals, funds, GPs, and investment programs. If it's helpful to you, subscribe and check out the website where you can download the Excel files behind every episode. This is video number 8 in the value creation series, where we continue to look at how leverage and growth capital drive private equity returns. In the last video, we used a bit of calculus to show that the leverage effect, as defined in VC104, could be split into gearing and cash flow generation. We won't go through that math again here, but it's an important addition to our toolkit. The derivative model allows us to break up the GP or fund level private equity return into a dilution or concentration component called the fund ownership impact and a hypothetical dilution neutral return called the isomeric return. The isomeric return can be broken into the unlevered return and the leverage effect. The unlevered return can be broken into EBITDA growth and multiple expansion. And now the leverage effect can be broken into cash flow generation, which is simply the change in net debt, and gearing, which explains how debt amplifies equity gains and losses, or how growth capital dampens equity gains and losses. Now, to make the math in this episode easier to follow, we will look at the total equity return instead of those for a specific shareholder like a GP or a fund. We do this by setting the fund ownership to 100%, which makes the delta phi term go to 0. This makes all the phi terms go away, leaving us with the total equity return drivers. Here is our main derivative model total equity value creation formula. It tells us that shareholder equity value is driven by EBITDA growth, multiple expansion, gearing, and cash flow generation. Okay, before we jump into the examples, let's tie up some loose ends on the value creation models that we discussed earlier. Here is the conventional model of value creation that we introduced in VC102. It's the version most often used out in the field, and we know that it tends to fall apart when net debt gets away from 0 because it can't really handle leverage or growth capital. However, we can use some of the things that we learned in the last video to change that. For example, we know that over a holding period, the average equity ratio and the average debt ratio always add up to 1. So why don't we multiply delta TEV by 1 in the form of ER plus DR? This gives us 2 delta TEV terms, one with the average holding period equity ratio and one with the average holding period debt ratio. Now, just like in VC102 or VC104, we can break the first enterprise valuation change into its EBITDA growth and multiple expansion components. And when we do that, we just arrived at the derivative model of value creation. We didn't use calculus, we didn't use natural logarithms. We just added a bit of algebra to the thing that everyone is already doing, and we get a far superior model that fixes all the problems with leverage and growth capital. To me, this is one of those things where once you see it, you can't unsee it. And it's so simple and obvious in retrospect that I'm personally embarrassed that I spent about 10 years of my career doing this the wrong way. Now, I'm sure that others have figured this out, but I've never seen the equity ratio or the debt ratio used this way in any academic or industry studies, and I've never seen it in any of the analysis templates used by LPs, GPs, fund of funds, or investment consultants. And I am making these videos because I really think that we need to change that. All right, speaking of academic studies, let's go back to the Munich Model of value creation that we discussed in VC103. Here the value drivers are the EBITDA effect, the multiple effect, the free cash flow effect, and their version of the leverage effect. Here the unlevering is being done with this lambda term, which is defined as follows. Now, in our video, we rearranged the terms to make the value drivers a little more intuitive as follows, but we're still stuck with lambda. We don't always have access to all the numbers that you need to calculate lambda, and as we saw in VC103, this formula tends to become volatile whenever there are high debt levels or large changes in debt. But what if instead of using lambda, we try to do our delevering with the average holding period equity ratio? We know that works just fine for the derivative model of value creation, it's not volatile, and you can calculate it with numbers usually found on the fund's quarterly report. When we do that, we get this expression. We remember that 1 minus the average equity ratio is the same as the average holding period debt ratio, and then making that substitution we arrive at the derivative model of value creation. This is great news. We have now come to the same equation from 3 different starting points. from the conventional model of value creation using algebra, from the Munich model of value creation using an intuitive substitution, and from the derivative model of value creation using basic calculus concepts like the product rule and the quotient rule. Okay, that's how it works. Let's look at some examples of how these should be calculated out in the real world. Here we have an unlevered deal that grows its equity from 100 to 180, providing a gross multiple of 1.8x. To get the derivative model inputs, we expand the table with deltas and averages. Given that there is no debt, we wouldn't expect any value creation to come from leverage, and that's what happens. The unlevered return makes up the entire equity return of 80, and the leverage effect is 0. That unlevered return includes EBITDA growth of 55 and multiple expansion of 25, and as expected, the average debt ratio of 0% gives us no gearing, and the net debt change of 0 gives us no cash flow generation, and all four components add up to the correct $80 million change in total equity value. Here is another deal that has the same growth in enterprise value, but net debt of 50. Equity grows from 50 to 130, providing the same 80 million of absolute value creation, but now we have a higher gross multiple at 2.6. Here are the deltas and averages. We expect leverage to play a role in this deal, and that's what happens. The average equity ratio of 61% lowers the unlevered return to about 49. And the equity ratio change provides a leverage effect of about 31. We see that equity ratio also lowers EBITDA growth and multiple expansion from the 55 and 25 that we saw last time. And then gearing makes up the difference. Our 39% average debt ratio attributes 39% of the enterprise value growth to gearing. Again, in this example, we have no change in net debt, so cash flow generation for the deal is 0, and when you add up the value drivers, you get the total equity return of 80. Alright, now let's try to grow enterprise value with a constant equity ratio. As TEV increases from 100 to 180, let net debt increase from 50 to 90. This means that the equity will increase from 50 to 90 as well. This provides 40 million of absolute value creation and a gross multiple of 1.8x. Here are the deltas and averages. Now, we expect leverage to play a role in this deal, but we don't see it right away. The average equity ratio of 50 lowers the unlevered return to 40, but there is no leverage effect because the equity ratio change is 0. That 50% equity ratio also cuts the EBITDA growth and multiple expansion values in half, but the 50% debt ratio means that half of the enterprise valuation growth is assigned to gearing. What's different in this deal is that we increased the net debt from 50 to 90, which is why we have cash flow generation of negative 40. We see no leverage effect on the left because gearing and cash flow generation cancel, and when you add up the value drivers, you get the total equity return of 40. Now, conceptually, this net debt increase could mean that we burned through cash that was on the company's balance sheet or that we went out and borrowed more money. Either way, we look at that as capital that was required to sustain the company's enterprise valuation, and it reduces the company's equity value creation. Here's another example. While the company grows enterprise valuation from 100 to 180, we pay down the debt from 50 to 25, generating 105 million of total equity value and a gross multiple of 3.1x. The average equity ratio tells us that the unlevered share of that return is 54.4 million, and the average equity ratio change gives us a leverage effect of 50.6. As with the other levered deals, the equity ratio works to decrease the EBITDA growth and multiple expansion terms, while the debt ratio works to increase gearing share of the enterprise valuation change. The net debt change gives us cash flow generation of positive 25, and when you add up the value drivers, you get the total equity return of 105. Now, the net debt change, it might have come from principal payments, or it may be the accumulation of cash on the company's balance sheet. Either way, that's capital that could have been distributed to shareholders, so I think of it as a delayed equity distribution that shareholders get on the last day of a deal. It's something that a GP should usually get credit for. When cash flow generation is negative, it's kind of like a delayed follow-on investment that was required to maintain the company's enterprise valuation, and you could give the GP credit or blame for that as well. Alright, one more example. Let's look at a growth deal where we have a revenue valuation instead of an EBITDA valuation. The math works the same way. Growth capital gives us negative net debt values, negative debt ratios, and equity ratios that are greater than 100%. Here the company grows enterprise valuation from 100 to 260 while burning through half of its 20 million of initial cash, generating 150 million of total equity value and a gross multiple of 2.25x. Here are the deltas and averages. Now the equity ratio makes the unlevered return higher than the enterprise valuation change, and this is offset by a negative leverage effect of minus 29 million. Revenue growth is the product of the revenue change, average revenue multiple, and average equity ratio. And multiple expansion is the product of the valuation change, average revenue, and average equity ratio. Gearing is the $160 million enterprise value growth times the average debt ratio of negative 11.9%. And what we see here is a measurement of the drag of excess cash on the company's equity value growth. This is because growth capital makes equity grow more slowly than the enterprise when things go well, but it also makes equity fall more slowly than the enterprise when things go badly. That's why I say that growth capital tends to dampen equity gains and losses, in contrast to debt, which amplifies equity gains and losses. All right, the last element is the $10 million increase of negative net debt corresponding to cash burned and $10 million of negative cash flow generation. And when you add up the value drivers, you get the expected total equity return of $150 million. Great, that's it for this video. The examples that we showed here are more detailed than the ones we normally demonstrate, but I wanted to provide enough detail for you to adapt and build your own models. As always, follow the link in the description to the episode page where you can download the Excel models for all 5 companies that we discussed here. And please stay tuned. We'll have more to say about growth capital and leverage in the following episodes. Thanks for watching. If you're into this sort of thing, subscribe and check out the website AUXILIA Mathematica. Registration is free and allows you to download Microsoft Excel files with all the data and charts used in these and other videos. On the site, you'll also find other resources like articles, templates, and a private forum for Q&A. When you visit, check out the site's free online value creation calculators. These web pages allow you to select various analysis parameters, plug in your own capital structure, P&L, and market data, and then measure value creation with a click of a button. I don't think that these calculators will replace your Excel models, but they're really useful for both preliminary investigations and double-checking that your own spreadsheets are generating the right numbers. I should mention that if you're looking for a convenient reference and training tool with a form factor of a college text, make sure to check out my book, Private Equity Value Creation Analysis, on Amazon.com. And finally, if you'd like to get up to speed with models like this more quickly than the book or the website allow, get in touch. Over the last 15 years, I've helped dozens of GPs build models like this for various fundraising and investor relations projects. Thanks for watching, and see you next time.